All eyes on risk, navigating geopolitical uncertainty. A warm welcome and greeting to all of you as we enter the fourth and final quarter of 2024. The U.S. economy and its markets remain on solid footing, buttressed by a resilient U.S. consumer that continues to spend, companies reporting healthy earnings growth, and now an easing cycle that began with a jumbo 50 basis point rate cut by the Federal Reserve. However, it is flashing plenty of warning signs, particularly in the labor market. Now, we anticipated this development and encouraged investors to begin underweighting equities back in July. We also advised them to turn more defensively in their portfolios by overweighting utilities, healthcare, and consumer staples at the expense of cyclical sectors. Since we published our Q3 quarterly on July 8th, U.S. equity markets are essentially flat as of the end of September. The S&P 500 is up only 3% and the NASDAQ is down 2%, but volatility has increased markedly with the VIX index up over 37%. So what caused markets to inflect this way midsummer? The catalyst was the publication of the U.S. July employment report that first alerted investors that all was not well in the labor market. Now, not all markets were oblivious to this plight. As of the end of September, U.S. 10-year Treasury yields plummeted from a high of 4.7% all the way down to 3.75%, and both oil and copper fell over 20 and 8% respectively from their May highs as well. Indeed, equity and credit markets have been more cheerful than government bond and commodity markets. A useful rule of thumb is that when equity and bond markets send conflicting signals, go with the bond market as there is usually smarter money involved. Away from the United States, things have looked gloomier throughout the year. The EU's largest economy, Germany, is probably already in recession, and China's economy is flailing. Trade flows could decline further in the months ahead. Loan growth has fallen to an all-time low, and the housing market continues to implode. Both European and Chinese markets have largely reflected this fundamental reality. But now that the Politburo has appeared to suddenly get serious about stimulating the economy, can the economy turn around? Indeed, there might be a tactical opportunity arising for Chinese markets to outperform developed ones over a short-term horizon. Turning back to the U.S., our views have not changed materially throughout the year, so we will simply recap them here briefly as a refresher. So far, the macroeconomic and market landscapes are unfolding largely as we expected due to our concerns surrounding a growth scare emanating from the labor market in the second half of the year. As a reminder, our year-end price target range for the S&P 500 in a non-recessionary scenario was between 5,200 and 5,400. Remember, we published these targets back in January when most of Wall Street was quite bearish and the index traded around 4,700. We will stick with those targets for now, implying a 6 to 9% drop into year-end from end of September levels, but still leaving the index in healthy positive territory for the year. Now, it should be noted that we expect annualized returns for the S&P 500 over the next 10 years to be between 8 to 9%. Dating back to 1927, this would be slightly below their historical return of 10%, but well below the 16% annualized return from the global financial crisis to 2021. Given the stability of our views this year, we wanted the primary focus of this quarterly to be the numerous geopolitical risks on investors' minds: the U.S. presidential election, the conflict in the Middle East, the Russo-Ukrainian war, and a few others. How do geopolitical crises affect financial assets? What should investors do when confronted with one? While we will explore some of these contemporary concerns shortly, one major takeaway from our investigations into the history of such events is worth highlighting from the start. For the savvy, risk-tolerant investor, it is wise to buy after the first shots ring out and markets plunge. Macroeconomic and market update. September's 50 basis point interest rate cut by the Fed sparked some enthusiasm in stock markets, echoing similar reactions from January 2001 and September 2007. In both of those instances, initial market optimism was followed by significant declines, suggesting that the Fed may have been slow to respond to underlying economic issues, a scenario that could be unfolding again. Indicators like the SOM rule, which analyze unemployment trends, are signaling a possible recession later this year or in early 2025. Now, some commentators are suggesting that the recent rise in the unemployment rate is for a good reason, namely that more people have joined the labor force. The problem with this view is that the uptick in the unemployment rate is not just due to more people entering the workforce. It is also a sign of slowing labor demand and an increase in job losses. Job openings have dropped close to pre-pandemic levels, and further declines could trigger a cycle of rising unemployment. Additional metrics such as the Conference Board survey, the quits rates, and the hiring rate all point to weakening labor demand. In addition, there is a growing number of people working part-time because they cannot find full-time positions. Moreover, consumer spending in the U.S. is expected to slow as rising household debt and increased delinquency rates on credit cards and auto loans are prompting banks to tighten lending standards and raise interest rates. Finally, the manufacturing sector is showing signs of contraction, with key indicators like the ISM Manufacturing Index and capital expenditure intentions weakening. In China, structural issues are hindering economic growth, despite government efforts to stimulate the economy. The effectiveness of monetary easing is limited as households and businesses are reluctant to borrow and spend, leading to a liquidity trap. Europe faces its own challenges, with consumers hesitant to increase spending despite having the financial capacity to do so. The labor market shows signs of slowing, and manufacturing indicators remain weak. Germany, in particular, is struggling with competitiveness due to higher wage growth compared to other Eurozone countries, and a reliance on a now obsolete business model centered on exports to China and cheap Russian energy. Overall, global economic indicators point toward a slowdown, with increasing risks of recession influenced by weakening labor markets, reduced consumer spending, and limited effectiveness of traditional monetary and fiscal policy tools. Now, will the Fed save the day? Unlikely in our view. Before the latest meeting, we believe that the Fed should have begun easing monetary conditions during the summer when unemployment started to rise noticeably. So we were glad to see the Fed move aggressively in September. Consequently, we anticipate a reduction in the likelihood of a recession in the near term. Indeed, our proprietary recession indicator, which analyzes over 40 economic time series and has been highly predictive over the past 50 years, though not infallible, reflects this diminished risk. Over a 6-month horizon, the indicator has decreased by more than 4% since last month. The primary reason for this decline is the recent release of resilient and positive economic data. Industrial production grew in August, and the initial September regional Federal Reserve manufacturing surveys have been encouraging. While August retail sales showed mixed details, the overall figures do not suggest an imminent recession, and housing starts saw a rebound in August. Despite these positive signs, we are not yet prepared to retract our forecast of a U.S. recession over the next 12 months. Aggressive rate cuts do not significantly change this expectation because monetary policy operates with long and variable lags. Additionally, the 50 basis point reduction still leaves monetary policy restrictive, as the federal funds rate remains above the Fed's own estimate of the neutral rate. Now, we employ another model that builds upon our earlier probit model by incorporating factors such as monetary and fiscal policy, potential supply shocks, military conflicts, and other geopolitical considerations to provide a comprehensive assessment. This model also indicates that short-term recession risks have decreased, but we continue to foresee a recession over a 12-month cyclical horizon for all the reasons previously discussed. Now, it is important to highlight that we believe the risks of a severe recession have increased as well. The trade-off to the Fed's assertive rate cut is a higher probability of a second wave of inflation. An economy that overheats in the short term might avoid a recession in the coming months, but could face a deeper recession later if the Fed is compelled to implement stricter measures. Because the likelihood of a recession occurring in the next 6 months has decreased, we might see stocks rise in the short term as investors anticipate a soft landing. However, given that the S&P 500 is at record highs at the end of September, it is our view that it is not an ideal time to initiate new U.S. equity market investments at this time. Even in the best case scenario of a soft economic landing, the index is unlikely to rise significantly from current levels. In the other scenarios, we could see substantial declines. The risk-reward trade-off is simply not compelling for U.S. equity investors as markets seem overly complacent about growth risks. We want to conclude with some thoughts on China. The recent announcement by China's Politburo has energized financial markets, sparking significant interest in Chinese stocks and related investments. This follows upon earlier policy easing by the People's Bank of China. Investors are now wondering whether China's policy shifts mark a meaningful turning point that will support the economy and financial markets. The policy measures have injected a burst of optimism, potentially leading to a period where Chinese equities and related assets outperform global and emerging market stocks due to their low valuations. As a result, we recommend adjusting the allocation to emerging markets from underweight to neutral within a global equity portfolio. In addition, we would also now upgrade Chinese A shares to overweight. However, the absolute performance of emerging market and Chinese stocks will largely depend on the global risk environment. If the current positive market sentiment persists, these stocks could rally further. Yet we are skeptical about the durability of this beyond the next few months. Risk-averse investors may want to initiate a relative value trade by going long Chinese A shares and shorting Indian equities. As this chart shows, Indian equities are extremely expensive compared to their Chinese counterparts, and some mean reversion is likely. This is a tactical trade recommendation. Over the long term, we do believe that Indian equity returns should outpace the Chinese bourses. Despite the recent policy announcements, we doubt that these measures will lead to a significant economic recovery in China within the next 6 months. Indicators such as credit and fiscal spending impulses suggest that the business cycle risks are leaning toward the downside, and a slowdown in Chinese import growth is expected. In conclusion, while the recent policy announcements have improved investor sentiment and could lead to better performance of Chinese stocks in the short term, more substantial measures are likely needed to stimulate a meaningful economic recovery in China. How should investors manage geopolitical risks? Before we turn to the concerns among the minds of many investors today in the realm of geopolitics, it is worth discussing an appropriate framework for such considerations. To begin, for short-term tactical asset allocation makes sense for investors to bet against market disruptions caused by geopolitical events when it is sensible to do so. Many investors view geopolitics primarily as risks that prompt caution and a retreat from bullish positions in their investment portfolios. However, historical evidence suggests that while geopolitical events can temporarily boost safe haven assets like bonds and gold, these effects are often short-lived. Risk assets frequently rebound more quickly than anticipated after major geopolitical incidents. If one analyzes all global geopolitical events from the 1956 Hungarian Revolution to the 2024 Iranian missile strikes against Israel, and marks the performance of the S&P 500 before and after the event, then the observations are illuminating. After the event, the average decline in the index from peak to trough is negative 10.62%. But 1 month, 3 months, and 6 months, and 12 months later, the index is on average positive. In fact, a year later, the S&P 500 is up 9.63% on average since 1956 after every major geopolitical event since the end of the Second World War. It follows that investors benefit from staying calm during such times of upheaval. Now, there appear to be 3 main reasons why risk assets tend to show resilience in the face of geopolitical risks. First are policy responses. Geopolitical crises often trigger pro-growth policies from central banks and fiscal authorities, as governments seek to mitigate against economic fallout. These policy shifts can serve as catalysts for asset appreciation. Second, the emergence of constraints. As material limitations become apparent, they narrow the range of likely outcomes initially considered by investors. While initial reactions may focus on a wide array of possible scenarios, over time, the understanding of what is probable becomes clearer, leading to more rational market pricing. And finally, there's desensitization and risk premium collapse. Markets tend to adjust swiftly to ongoing risks, and investors become desensitized faster than expected. As a result, the additional risk premium associated with geopolitical events diminishes, often more rapidly than human sentiment does. Investors should recognize that objective measures of geopolitical risk, such as media coverage, physical damages, or casualty figures, are distinct from market measures like risk premiums. Even when a conflict remains intense, markets may adapt quickly, causing the risk premium to shrink as investors adjust to the new normal. Geopolitical events, therefore, can present opportunities as well as risks. The tendency of media and the average investor to overstate geopolitical dangers due to the difficulty in quantifying them creates informational asymmetry. Savvy investors can exploit this by betting against worst-case scenarios, thereby generating significant returns as exaggerated risk premiums fade. The current situation in the Middle East is illustrative. Despite escalating tensions between Israel and Iran, oil prices did not surge as anticipated. This is attributable to Iran's strategic decisions influenced by material constraints and a market that had become desensitized to ongoing geopolitical risks. Iran has avoided actions that would disrupt global oil supply, partly due to its recent détente with Saudi Arabia and its interest in maintaining regional influence without provoking further conflict. Using a constraint-based framework when analyzing geopolitical risks allows investors to better assess the probable outcomes rather than the merely possible ones. This approach keeps investors disciplined amid overwhelming news flow and allows them to identify opportunities by considering second and third order effects rather than just immediate reactions. U.S. election update of bulls, bears, and polls. From now until November 5th, and probably until January 2025, the U.S. elections will remain the key factor when assessing investment decisions and asset allocation perspectives. Therefore, we deemed it fit to revisit how the landscape has changed since our last quarterly call, how the changes have affected the market and probable election outcomes, and what we expect in the final stretch until Election Day. In this atypical election, we had one of the candidates enduring 2 assassination attempts, and the incumbent Democrat candidate abandoning the race while anointing his successor only months before the ballots are cast. Oddly enough, the general landscape has not changed much since we last revisited it. Still, the elections will affect the path of the global economy regardless of who enters the White House. Even if the polls have been considered flawed and wrong on previous occasions, it is still useful to review them to gauge the political landscape. When President Biden was still in the race, the U.S. election seemed like a sure victory for the Republicans, with Donald Trump being consistently ahead of President Biden, with voting intentions for him being the highest right after the first presidential debate. However, the average polls flipped shortly after President Biden stepped away from the presidential race while appointing Vice President Kamala Harris as his successor for the 2024 election. Even if she only accepted her nomination at the end of the Democratic National Convention, she gained momentum from undecisive voters and Democrats who were not content with Biden's candidacy, while appealing more to independent and moderate voters. This momentum, coupled with a strong fundraising campaign, led Harris to close the gap with Donald Trump. As we write this report, Harris is ahead of Trump by 2 points according to the Real Clear Politics poll average. However, Harris's advantage per the polls is still narrow, and the election remains a toss-up, as can be seen in the following graph. Meanwhile, the betting markets initially exhibited a narrow probability of Trump winning the election, with that gap widening in tandem with the observed increase in President Biden's disapproval rating. The increase in Harris's popularity also propelled her betting odds, with her biggest spike occurring when she accepted the presidential nomination. From then on, the average of the betting markets, calculated by Real Clear Politics, has mostly favored Harris. At the time of this writing, and as this graph portrays, the Harris-Trump spread stood at +2, underscoring how close this election should be. Now, according to most analysts, this election will be defined by voters from so-called swing states. Some have stated that this electoral process has become a competition for a collection of states amid what has been deemed a record low share of undecided voters. This in turn has been described as something that could increase Harris's potential voter base. The latest polls in the swing states at the time of this writing similarly portrayed a tight race. Harris had a 1 or 2 point lead at a maximum over Trump in Michigan and Wisconsin, respectively, while both candidates were virtually tied in Pennsylvania, while Trump carved a 6 point lead in Ohio and a slim 1 point lead in North Carolina. Now, both campaigns have been more focused on personal attacks than on substantive policy discussions. However, based on the available information from both parties, Harris's economic agenda is projected to continue many of the initiatives from the Biden administration, while Trump's economic agenda emphasizes tax cuts and global tariffs. Harris's most notable policies include raising the corporate tax rate from 21% to 28%, increasing taxes on capital gains, investment income, and stock buybacks. On the other hand, Trump's key proposals feature a 10% global tariff on all imports, with a 60% tariff specifically for China, the extension of tax cuts introduced under the 2017 Tax Cuts and Jobs Act, and the introduction of new tax cuts. In sum, Trump's approach seeks to fund the nation's fiscal needs through tariffs, while Harris' strategy focuses on generating revenue through higher taxes. Regardless of the proposed path, whether through tax cuts or social programs, both candidates' plans are expected to exert additional pressure on the fragile fiscal picture of the United States. Analysts from Citi estimate that Harris's economic agenda could increase the U.S. fiscal deficit by nearly $1.9 billion, while Trump's policies could lead to a $4.6 billion deterioration. As a result, fiscal concerns are likely to dominate market discussions regardless of the election outcome, especially in cases of a sweep by either party. We revisited our previous analysis on potential asset price movements across the 4 election scenarios, and our outlook remains unchanged. The debate surrounding these 4 election scenarios revolves primarily around corporate taxes and global tariffs. In this analysis, we will focus on the Republican and Democratic sweep scenarios, as these are the most transformative and likely to drive significant shifts in market dynamics. In contrast, divided government outcomes are expected to be more market neutral, as legislative gridlock would make it difficult for either candidate to pass substantial reforms. On the equity front, Trump's proposal to reduce the corporate tax rate to 15% is expected to boost S&P 500 earnings by 4%, while Harris's plan to raise the corporate tax rate to 28% would likely reduce earnings by around 5%. Trump's tax reforms could propel 2026 S&P 500 EPS growth from 12 to 18%, whereas Harris's approach would slow EPS growth from 12 to 5%. The Democratic sweep is seen as the most negative scenario for equities due to its direct impact on earnings, free cash flow, and corporate balance sheets. In this scenario, large cap stocks are likely to outperform small caps, as larger companies typically generate a greater share of their revenue offshore, which would help them mitigate the impact of higher U.S. rates on their effective tax burdens. Even if Harris' corporate tax hike will not resolve the U.S. fiscal gap, it offers a more sustainable solution to the country's current fiscal deficit. On the fixed income front, even if both scenarios would have a negative impact on U.S. Treasuries, the magnitude would differ by a party. Under a Republican sweep, lower corporate taxes are expected to drive yields higher, together with steeper curves due to fiscal concerns. Although reduced tax collection will hurt government revenues, the proposed 10% global tariff is expected to partially offset the fiscal impact. If the global tariff proposals are implemented, U.S. high-yield debt will likely outperform investment grade, as high-yield companies generate more domestic revenue compared to investment-grade firms. In addition, a lower corporate tax rate could reduce the incentive for companies to issue debt for tax benefits, which might result in less debt issuance, a potential positive impact for credit markets. In a Democratic sweep, higher corporate tax rates could improve the U.S. fiscal outlook, but concerns over midterm GDP growth due to potential job and wage declines offset the positive impact on U.S. Treasuries. Markets anticipate slower growth, which limits inflation expectations and tempers rate increases. For the dollar, Trump's 10% tariff on global trade is expected to strengthen the dollar and weaken EM currencies. While countries can impose tariffs on U.S. products as retaliation, overall, tariffs are expected to benefit the greenback. JP Morgan analysts estimate a 4 to 6% dollar appreciation under a 10% global tariff scenario. On the EM side, the Chinese renminbi and the Mexican peso are two of the most vulnerable currencies to the Republican policies. Potentially, the Chinese renminbi would be the most affected currency as we might experience a trade war 2.0 with a 60% tariff on Chinese imports. On the Mexican peso side, as Mexico became the largest commercial partner of the United States, the 10% tariff will affect 80% of the country's total exports. Conversely, a Democratic sweep will act as a headwind to the US dollar, as a reduction in risk premiums related to global trade tariffs and a less fiscal expansionary scenario weigh on the currency. Finally, on the commodities front, gold's strong fundamentals are expected to remain intact as the metal continues to serve as a hedge against inflation, geopolitical instability, and fiscal uncertainties. Oil and energy prices should remain stable despite Trump's promises to lower them through increased production, mainly due to the lengthy timeline that these changes require. The deregulation process required to boost production would need congressional approval, followed by significant capital expenditures from energy companies to achieve desired output levels. However, we can argue that Trump could achieve some immediate effects by putting pressure on Iranian oil or by facilitating a potential resolution to the Russia-Ukraine war, which might lead to the reintroduction of Russian gas supplies into the market. Beyond these scenarios, we do not expect significant changes for commodities under a Republican sweep. On the contrary, under a Democratic sweep, renewable energy assets are likely to outperform, driven by Harris's proposed energy transition initiatives. Other assets will remain largely unchanged. The scenarios outlined focus solely on the direct impact of each candidate's economic agenda without factoring in broader macroeconomic variables such as inflation, unemployment, and overall economic conditions. Regardless of the election outcome, fiscal uncertainty will dominate market discussions in the years ahead, posing a significant risk to U.S. leadership on the global economic front. Insigneo Financial Group, LLC comprises a number of operating businesses engaged in the offering of brokerage and advisory products and services in various jurisdictions, principally in Latin America. Brokerage products and services are offered through Insigneo International Financial Services, LLC, headquartered in Puerto Rico, and through Insigneo Securities, LLC, headquartered in Miami. Both are members of the Financial Industry Regulatory Authority, FINRA, and Securities Investors Protection Corporation, SIPC. Investment advisory products and services are offered through Insigneo Advisory Services, LLC, an investment advisor registered with the Securities and Exchange Commission. In Uruguay, advisory services are offered through Insigneo International Asesores de Inversión Uruguay, SA, Insigneo Asesores de Inversión Latam, SRL, and Insigneo Asesores de Inversión de Uruguay, SRL, in Argentina, and through Insigneo Argentina, SAU, and in Chile through Insigneo Asesorías Financieras S.p.A. Collectively, these 8 operating businesses make up the Insigneo Financial Group. To learn more about the broker-dealers, including their conflicts of interest and compensation practices, please go to https://insigneo.com/disclosures/ or via www.finra.org. To learn about Insigneo Advisory Services and any conflicts related to its advisory services, please see its Form ADV and brochure, which can be found at Investment Public Advisor Public Disclosures website, https://advisorinfo.sec.gov/.